After the past two episodes on the social cost of carbon, I want to return to our main tool in fighting climate change, and that is carbon markets, and more specifically, the EU's emission trading system. Now, on this podcast, we have already covered it quite a bit its history, how it works, and possible future developments. But one element we haven't tackled yet is how to tackle non compliance by firms. Because you can set a cap on emissions all you want, if firms don't follow the rules, then it might be for nothing. And carbon markets are relatively new, so this problem can be challenging. And so when I discovered a paper called Policing Carbon Markets that tackles this exact question, I was very excited. And this paper was published in Climate Policy in 2025. And this paper presents the first comprehensive analysis of the EU emissions trading system. It combines some amazing data collection with great analysis. So I'm delighted to have one of its authors with me today to discuss that paper, and that is Frank Venmans. And Frank is an associate professor and deputy research director at the Grantham Research Institute at the London School of Economics. He studies how we can design effective climate policy under uncertainty, with a particular focus on the path to net zero, technological change, inequality, and climate risk. And his work combines economic modeling with empirical research on carbon markets, climate litigation, economic growth, biodiversity, and carbon removals. And with a background in forestry and soil management, he brings a broad perspective that connects economics, climate science, and policy. So, Frank, welcome to the podcast.
Hello, Arvid. Thanks for inviting me.
I am very excited to have you on. As I say, sometimes I'm curious about something, then I see the paper, and I thought it was a really great paper. So maybe just to start, what question are you trying to answer in the paper?
So the first question is how was compliance? So what is the compliance rate? And there we observe relatively good compliance. And then the second question is what can explain the fact that some countries do better in compliance than others? So what are mechanisms that regulators use and maybe also see today differ between countries and does that explain part of the non-compliance? And then the other point is also enforcement. So what happens if there is non-compliance? What are the consequences? And there the general image or result is that the consequences are not dramatic. And that brings us then to a bit of a contradiction. How do we in a standard model we would think, yeah, if you're a company, you're maximizing profits, and there is this opportunity to cheat, then you weigh the consequences of cheating, like the punishment and the likelihood of punishment, against the gains of cheating, and you would then optimize. But that model turns out to be not very well validated by the data. So we have a bit of a puzzle in this in this paper, and we haven't completely solved it, but we are looking at different elements of data that can explain compliance, high compliance, and relatively low enforcement.
Could you talk more about the rate of compliance that you found?
So on average, there is 98.8% of companies that are compliant, and that is excluding 2005. 2005 was the first year, and it was very bad. So I can explain, like we did interviews, etc., why this was hard. In 2005, 22% was non-compliant. This was a trial phase. And it was also a trial phase because the system was set up very rapidly. So the white paper comes out in 2003 and they start trading in 2005. And that's why it was also smart to make this a phase that is completely isolated from the other phases. So you cannot bank your allowances that you have left in 2007 to use them in 2008. So whatever goes bad in the first phase is just isolated in the first phase. So that is like a high level of compliance.
Exactly. It's like pretty much 99% of all firms are just
Exactly.
compliant. Were you surprised by this magnitude of compliance?
Um, we didn't necessarily have an idea before starting the project. I think that more generally, for these big industries, when there are environmental regulations, there is uh, a preference to comply. And what is also specific to the EU ETS. So if you have a command and control rule and you have a benchmark and you're not allowed to have whatever PM10 beyond a given level, and then it does happen because something goes wrong in your oven. There is no real solution. In this case, if you emit more than your free allocation, then you just buy allowances. So then it's it you're in a different situation. Non-compliance is really a choice. Is I would say cheating. I've used the word cheating, but then when we go into the details, there is also a lot of some companies didn't know they were in the system, and so I had this phone call with the Italian regulator, and they say we were taking our phones and calling up these companies and say, you know you're in the carbon market, you know you need to have a report on your emissions, and they didn't know, and then then they're non-compliant, but then they make a report and then they give in their allowances too late, and then still I wouldn't it's not really cheating, it's actually being badly informed or sloppy on regulation. But that is what we found behind the scenes when we did the interviews.
Exactly. And that's why, like, it's good to have the first phase, but then once that first phase of like kind of being misinformed and I wasn't aware passes, then it seems like firms are generally complying well. And I think that's an interesting point that you mentioned. Like, if you have a regulation standard, and I hadn't really thought about that, you just have your own factory if there's no cap and trade, and then you emit too much, but you've got this very dirty technology. It's not easy to switch that. Whereas if there's a market, then it's almost like you say it's a choice because you can just buy more. Um,
Yes,
and
exactly. And it can be like, I take the example of an oven. So if something goes wrong, you have an incident, and your oven is not hot enough, it's going to generate a lot of pollution. Like there is this optimal temperature, optimal inlet of oxygen to get all these parameters right. A bit like your heating system. If there is not enough oxygen or oxygen, then you get all this soot out of your chimney. In these events, they're non-compliant. It was not necessarily meant to be like that, and then that
and
situation is not possible in the EU ETS, where you buy
yeah,
whatever you lack, you buy, and so it's some in that sense easier to comply.
and then I think that maybe then that's a good switch to go to the fines. So there's a relatively like there's a high compliance rate, but then you also looked at the fines, though. So could you talk about those?
Yeah, so we calculated the theoretical fine, assuming that what we observe is maybe I should make the high compliance a bit more precise. The high compliance is the official compliance code that regulators give to the companies. But we see in the data that some they get a code A, which is compliant, but actually there is not enough allowances to cover the emissions. And we see that actually they were late because they paid extra for the next year. So that must have been, maybe it's 2 weeks late, maybe it's a month late, and then the regulator says, okay, it's fine, we're gonna have a blind eye for this, because the reality is that they were fine. They just did the admin too late. So we don't call that, or yeah, we assume that if the regulator says compliant, it's compliant, even if the data show us that actually it was too late. Or and so if we take all these non-compliant companies, we multiply by the carbon price of the year, we get 13 billion fines, because there is a single fine that is for the whole, set by the commission, that applies to all countries. And so it's 40 euro per ton in the first phase, and then it switches to 100 euro per ton, and then in the second phase. And so this switch is yeah, even though you have to pay the fine, you also have then to pay the missing allowances, that for the preceding years. So it's not the case that with non-compliance you could, the cap would not be met.
Yeah.
So it's very expensive for companies to get fined. So that is 13 billion that should have been. But that is a theoretical fine, and so we find traces of 2.1 billion that was collected. So that is less than 20%, let's say 15%. So often there is non-compliance, but there is no fine associated with that.
Because then, is that a choice that the regulator has, or is because it?
Um, One complicated issue that comes back in many of the interviews is when companies close. So they close. The regulator finds there is non-compliance. They contact the company. The company is gone. Like, there is nobody in the office. Now they block the account, and in the best case there is still allowances in the account, and that covers the emissions, then actually things are fine, but it's not a non-compliant letter.
Yeah.
In the worst case, they have sold everything in trying to stay afloat, and then it's non-compliant
Yeah.
in the true sense that actually they have not covered their emissions with allowances. But they're gone. So then this is a fine that um, they can then go into a judicial procedure, but it's against the company that is closed. So they're not
Yeah.
going to lose too much time with that. It's going to take years, and so then that's one of the explanations why some of the fines are just not collected.
Okay. So, and I think that's the really cool thing about your paper. It's like you observe the compliance rate now. It's like 99%, so that's high. You've observed the fines, which is like 13 billion theoretical, but then they only collect 2.3 billion. And then once you set that, then you're starting to look in the explanations. Before that, though, I in your paper you also have this really interesting angle. It's like, you know, how can we make sure that the reporting is truthful? And there you do really interesting statistical tests. Could you just quickly talk about how you try to get at the truthfulness of reporting?
Yes, so one is the Benford's law. So Benford's law predicts that if you have the amount, the emissions that are the verified emissions, if they are the truth, by the fact that we have the whole distributions from small companies to very large, the leading numbers follow a power law. So, for example, 1 is a common number, because from 1 to 200 is more likely than from 900 to 1000, if you have a mix of small
Yeah.
and big companies. So we know the prediction of how often a 1 should appear in the data, and we check this law. And so in manipulated data, the law doesn't apply because it's manipulated. And in true data, we would expect the law to be applied. Now, the general picture is that the law applies. So we don't see from there any cheating or misreporting going on. Then the only thing that we can say is that once that fine goes to 100, we look at how large companies, which have a very strict level of precision in their verification report, they have to be correct on a 1% error maximum. Whereas the small companies, they have other methods to avoid too much
Yeah.
verification cost. They can go up to 4% measurement error, and the smaller companies start having a bit of a larger deviation from Benford's law. Now, there are no statistical tests that we can do with these comparisons. It's very suggestive. So
Yeah.
maybe there is something going on, but the general picture is it applies. We don't see evidence of random numbers, people that
Yeah.
or misreporting. And then we're also interested in what is the effect of specific um, of differences in regulation between countries. And so one example is that some countries, they can the regulator can appoint the verifiers. So the verifier is a third party. Maybe it's Vincent, or maybe it's Deloitte, or it's a separate entity, and they get credited by the regulator, and so they make the report. The company doesn't make its own report. But so since the company pays the verifier, there is a bit of a conflict of interest. So some countries appoint a verifier or have the possibility to appoint a verifier. The company doesn't choose its own verifier. And so then we look at two things. Does the compliance rate improve when the regulator can appoint a verifier? And that turns out not to be the case. And then we also look at so each company has a level of free allocation. Not electricity companies after 2012, but for a lot of the period, most companies have a free allocation, and that can be interpreted a bit as their benchmark.
Yeah.
And so companies that want to cheat might think like, let's underreport a bit so that I don't have to buy allowances. And so then under a cheating scenario, you would see that those verifiers that are playing together with the company that pays them, they would bulge their reports closer to the level of free allocation. So that is a hypothesis that we test, and we don't find evidence for that. So we test bulging around, like how many reports are just beyond the free
Yeah.
allocation, so that they need to buy, or just below, and that would then maybe be the cheater. But we don't see a real pattern, and we test for other uh, dif- other properties too. So another property is some countries, they can train and supervise verifiers. So the regulator can train and supervise verifiers. That also doesn't make a big difference. Or in some countries, the regulator can do its own on-site inspections, and yeah, that's the third one that we check. It doesn't explain much of the variance.
Yeah. So then you also then looked at variation of, I think, fines and probabilities of getting caught across EU, or is that kind of what you just were alluding to?
Um, yes, so that is another test that we did. So
Yeah,
we were saying, let's test the canonical model
yeah,
that a company maximizes profit and then does this weighting. Like if I cheat, then I don't pay the carbon price. But then the cost of cheating is the likelihood of getting caught, and then times the fine if I get caught. And so, do we see that in countries where there are higher levels of where the likelihood of being fined once that there is non-compliance is high, does these companies have better compliance? And we find that they do. So if you fine more, you have slightly better compliance, but
yeah,
that explains very little in the data. I've forgotten the number. I think it
yeah.
was 10% or 5%. There is a lot of variation that is not explained by the canonical model of profit maximizing cheating. So yes, so that was one of
Yeah.
the other tests that we did.
Yeah, and I think that's then where you get really interesting. It's so you've got this high compliance, but then you look at the classical explanation of fines and probability of being caught. It explains a little bit, but the vast majority is unexplained. So how then did you proceed to see if there were other explanations for this variation?
Yeah, so this is actually not new. So this is what we call, or no, what is called the Harrington's paradox. So that is a paper of 1988 establishing for the U.S. water pollution that there is high compliance and low enforcement. So fines are rare, but most companies do a lot of comply to the pollution environmental regulation. And so that is explained by so initially it's a puzzle, but then companies their economists have thought of explanations why that can be. And so one is, for example, naming and shaming. So when there is a company that is polluting, you can create reputational damage as a regulator and name and shame, so that the incentive for the company is larger not to the incentive is larger to comply. And so we saw that actually naming and shaming is explicitly it's an explicit policy of in some countries, and is not an explicit country policy in other countries.
What do you
And
mean
so we were yeah
explicit? Like it's literally written in their guidelines that they will publish the names, or
yes. So each country has to fill in a report each year to the commission explaining and so several answering several questions. And so one of the questions was, as I explained, do you appoint verifiers, or does the regulator have the authority to appoint verifiers? That's one question. Another is, do you apply naming and shaming for non-compliers in your country? And so in practice, registries of a country would have a website, and it would report emissions, and it would then also have the option to report their companies that are non-compliant.
yeah,
On top of that, the EU has also the EU ETL, so the official registry for each installation is, you can look that up on the website. That's a centralized website of the EU. That's how we also get the data. So there is naming and shaming anyway, but if that is just one of the 12,000 installation that
yeah,
is non-compliant, and nobody puts that on us, so on on a website or on in a press conference, then it's companies could hope that
Yeah.
nobody sees it. So yeah, so then the question is, does naming and shaming work? And so, but we look at compliance rates of countries who apply it and countries that do not apply it. Now, actually, we find that countries who do name and shame get better compliance, a bit better, but it's not significant. So then we check, like, if we see a pattern in this difference. And so normally the pattern would be that if you are a listed company, you care more about reputation because you have to please
Yeah. Your
your
stockholder.
shareholders. Yeah. So, but that turns out not to be the case. So naming and shaming does not work better for listed companies, and it also doesn't work better for domestic companies that have their headquarter in the country. So being domestic also makes you more sensitive to naming and shaming. And again, this doesn't turn out to be the case. So then we conclude that actually the effect is probably very low, or zero, like not non-significant,
Yeah.
and we don't see the a
Yeah.
pattern there.
Which is
Um,
back to like the Harrington's paradox. It's like we see very high compliance rates, but then the enforcement mechanisms themselves don't really seem to have all that big of an impact.
yes. So the paper is a bit of seeing the Harrington paradox as a true paradox because several standard explanations of the Harrington paradox are we don't find evidence for them. For example, one thing that a regulator can do, it is saying if I see non-compliance, I'm going to punish you in a different way because we know each other
Yeah.
and I have power and I'm going to make your life hard. And so in the EU ETS, it would be if I see non-compliance in the next phase, I'm going to set your free allowances lower.
Yeah.
Nobody like no, there is no court involved, there is no fuzz, there is, it's just but the company knows because so we test that. So does do we see lower free allocation for non-compliant companies? And yes, a bit, but it's non-significant.
Yeah.
So it could be a mechanism in the past. This mechanism is now also no longer possible because free allowances is no longer
Yeah.
the authority under the authority of the national regulator. And it's based on standard rules. It has been harmonized, which was actually a very good idea. Um, but yeah, so this explanation is no longer possible. Another one would be the regulator, if this is command and control, so the regulator knows which company has a hard time to reach the norm that is set. Think of water pollution or air
Yeah.
pollution like PM10, and it's going to verify the one that is most likely to not to comply because it knows it's very expensive to
Yeah.
comply for this company. And that is not possible here because the marginal abatement cost is the same for everybody. You're in the
Yeah.
market. If you have costs above that, you buy. If you have costs below it, you sell. You avoid them. And so yeah, so this discrimination on costs is not possible. Now, another idea is if you don't comply, we suspend your license, and that is a very big threat.
Yeah.
So apparently, some regulators have the power to suspend, and others have not. And so we checked for that. Now, in the data, that doesn't give a significant difference in non-compliance. Um, but I think from the interviews that is actually something that is really going on. So these companies, like I did interviews with cement and brick companies and lime,
Yeah.
big companies. they're there since 40 years. They have 30 years left in their quarry, and this is a long-term relationship with the regulator. So the
Yeah,
regulator is there for decades. They're there for decades, and if you mess with the relationship, it's not smart.
yeah,
It doesn't, and so I think that is part of the story. They at some point they might want to expand their production. They need an environmental license for that, or the environmental license needs to be extended. So whenever they can please the regulator at low cost, that makes sense. So I think that's the case. But when we test it formally, and so this difference where some regulators can have the power to suspend, we don't see a significant difference.
and
Uh,
it's also very big action on the regulators part, like shutting down production is a huge
yeah,
thing. I could
it's
see
not.
how.
You're not going to
Yeah.
make yourself popular.
Exactly. Like the
So,
local politicians also
so
will not be.
that is always in the background of climate policy. That it can be politically costly to impose emission reductions. Like generally, you don't make yourself popular with climate policy. And so harsh action on companies is not that politically profitable. It somehow contributes to the paradox. So
Yeah,
if the company knows that actually they're employing many people, and so it would be hard for a politician to go after them, they might prefer to cheat. But then I think it's this long-term relationship that is
exactly.
dominant, because we do see that sometimes companies want an extension, and they don't they want to, yeah, an extension of the existing license, or they want to expand their production capacity, and that's often politically sensitive too. Because if you want to, this is industry, no, that gives
Yeah,
you dust, it gives you all kind of pollution, and so sometimes local opposition is really a problem, and
yeah.
so
Because
they
it's
want.
true. Because in the classical framework, it's like a one-off almost. But here, like you say, it's a decade-long relationship. You don't want to really be caught cheating on some
Yes,
amount where
exactly.
where it would be relatively easy, and if you're missing like 10% of your emissions, just buy them and keep the relationship and trying to cover it up, so to say.
Yeah. So yeah, it's what we would call in economics. It's a repeated game, and
Yeah,
repeated games are more find it easier to find collaborative solutions. So yeah, and then we also look at if so that there are actually there is the official fine, which is the same for everybody. That is a fine per ton, 40 or 100 euro per ton, and then countries can also add legal fines. And so these legal fines go from 0 to 15 million for misreporting. And prison penalties go from 0 to 10 years of prison for misreporting. And so we look if that explains the existence of high fines on top of the existing fine, if that explains compliance, and it the relationship is weak.
yeah.
Um, so
So in that sense, that's why you say it's some like the paradox here seems almost like a real paradox, because all the explanations that you analyze in detail, there's weak relationships.
yes, so I must confess that we haven't really solved the paradox.
Yeah,
We have tested many standard explanations, and they we don't find statistical
yeah.
evidence. So a thing also would be,
Th-
you could have higher penalties for repeat offenders, if this is in standard regulation, companies that would repeatedly exceed the norm. But here, as the penalty is set by law, you you can't apply that easily. Now, the fact that sometimes there are non-compliance, but there is no fine, means that actually you can threaten the company, saying like, next time I'm not
Yeah.
gonna close a blind eye. So next time it's cash, and so then that would still be a valid explanation why companies do not repeat offend.
Which brings me to a part of your paper that I also really found interesting is that you did the interviews, as you said, with these enforcers
Yeah.
and kind of getting deeper into what's going on. Could you give a few takeaways of what you found during these interviews? Because now you've done all this analysis, you've got some observations. Like, what did you learn from these interviews?
Yeah. So these interviews were very fun. I was mainly trying also to understand the data, because I think many economists and maybe policymakers and maybe now people in that are setting up ETS systems underestimate how hard also the technical side is. So this was an European project. They needed everybody on board. Not every country is motivated to the same extent. And so the initial solution was registries are managed by the country. Uh, Now, that is not the best way to manage a central, like a big registry. And
Yeah,
so protocols are very complicated on how you send your data to the central registry, and how you communicate this. And so in France, they used an external IT company to help with their registry, and then they made an error. And so at some point, whenever there were foreign allowances implied, the registry didn't register, like coded an error. And so there was a lot of missing data, and yeah, it was an error, and the data was gone, and so that it gives them a lot of missings.
yeah,
Now they still can yeah, give the codes and say this is compliant, because they may know the reality, but it's there is a data issue, or so I had also a phone call with Malta, and then there they said they took 2 years to decide if they needed a registry at all, because they have only two installations, and it's very costly to start a
yeah,
registry for just two installations. It's a bit ridiculous. But then the decision was made to have to have a registry. And then I said, but in the EU database, your two companies, it's missing all the time. And he said, but I have the data. Like in my registry, it's there. I can see the allowances. I can see the verified emissions. I can see the emitted quantities. And so there was some communication difficulties with between the registry in Brussels and the local registry. And then in the interview with the central registry, I said, like, I did tests on the data. So the normal data tests that you would do in good research. So for example, there is one data point is cumulative emissions, and then I also have the emissions each year, and so I can check if these cumulative emissions correspond to the emissions of the preceding years, and sometimes they don't. So then and these are simple checks, like
yeah,
in the statistical checks, like normal data cleaning. And so I say, here, this company, the cumulative emissions are different from the daily emissions. Like, how can that be? And then at some point you become very nervous. You say, like, what are you doing? Like, are you like trying to ruin us? Or he thought
oh,
that I had like like an agenda of destroying yeah, the reputation of the EU ETS. And that is another thing. So when you see, so in the appendix we have a description of things that are a bit that show that actually managing a big data sets where with many parties involved is hard. And
yeah,
then you see also that when that it becomes a centralized data set in 2013, I think, it's obviously easier. So there is
Yeah.
just one manager. They have a single system. That's obviously the better way to do this. But again, it's politics, no? Like you have to convince 28 countries or 30. Actually, Norway and Switzerland are also in, or Liechtenstein. And yeah, it's how the real
Yeah.
politics play out.
So then, you know, because I want to be mindful of your time soon. What would then be your takeaway be of this paper? So you've investigated. We've got this high compliance rate. Some of the fines are not paid. You've looked at these analyses. So what would be kind of your takeaways that you would have from this paper?
So one takeaway is connecting to my preceding point. So it is if you're Vietnam or Mexico or Indonesia, you're setting up your ETS. So be mindful of the technical complexity. And so that also asks the question like what is the body that is going to enforce and what is the regulator? So if you can put set this into your tax or a government body that has experience with collecting money and with managing data of companies and these standard elements that are common with tax policy, that would be um, helpful. Don't underestimate the complexity of these things. um, don't underestimate the extent to which criminals can also exploit the fact that you've created an asset with a lot of value. There has been problems with, we describe it in the paper, like with VAT carousels. At some point, huge volumes traded were actually just VAT carousels, leading to lots of up 5 to 10 billion lost income in VAT, because it's an asset that has a lot of value. And initially in the EU ETS, the checks, the identity checks, particularly for those who are trading, were weaker than for
Yeah.
standard financial assets. And so that is now solved. So allowances are under the financial regulation considered as similarly to stocks and bonds and other financial assets. So regulation is now, these VATs carousels would be very hard today. But that is so there is this technical complexity that is quite important.
Yeah.
And then even though we find it hard to distinguish between relatively small details in enforcement and compliance regulation, I don't think you can say that none of that matters. So we also have,
Yeah.
but there is this paper in India where they look at appointing verifiers, and they see there is a lot of corruption where companies uh, uh, influence the verifiers, and so many verifiers says they see that when the verifiers are not appointed by the companies, that actually the measurement and reporting is much more truthful. So we don't find that, but they find a big effect in India. So the context matters. Like Europe is probably a relatively easier area in the world where you apply this. So yeah, I think that is then also important to be conscious of the difficulty of compliance. I don't think you can take it just for granted, even if we
Yeah.
see that we have 99% compliance.
Exactly, in this context,
Yeah.
but they can all in other contexts be very important. I think that's, it's like given the constitutional given the framework here, they don't matter the biggest, but like in other contexts, they can definitely matter. So I think
Yes,
it's
exactly.
okay. Well then, I want to be mindful of your time, Frank, because we said 11.
Very good.
So then, thank you so much for coming on. I think this was really, really interesting for people, and I think it's really diving deep into this one really important aspect, which is how to make sure there's not a big non-compliance. So, thanks so much for taking the time.
Thanks for inviting me. It's very, I'm very motivated to make my results and my research also known to the wider public, because all this should serve the cause. No, like people should make. Yeah, I think ETS systems are on the up. Many systems are being starting up. There are dozens and dozens in many parts of the world, and so the European experience since it was the first and a very large experience, it serves as an example, and so we should learn as much as we can from this experience.
Awesome. Thank you very much, Frank.
Good.